Before you swipe right on that dream home, let's see if your budget can actually handle the heat. On today's episode, we have my primary partner and former realtor, Roger Grayson. Thanks for being here, Roger.
Yeah, thanks for having me. So, Kiki, I know you get a lot of questions. Here's one I heard someone ask the other day. Can you help me figure out what my payment would be if I bought a home for $900,000?
This almost kills me because I wish I could just answer the question, but the answer is it depends. There's a lot of things that go into a mortgage payment. And really, the best person to answer that question is a mortgage lender because they will have a full financial picture of your situation, and then they're able to tell you the exact numbers. However, that said, let's talk a little bit about what goes into a mortgage payment because, there's usually 4 and sometimes 5 pieces that are all wrap up to make your one mortgage payment. And that's that PITI and PMI.
Pity?
Pity. So,
Pity the poor fool who don't get my mortgage.
so the P is for principal. So that's the piece of the loan that you're paying off that month. The first I is for interest. T is for property taxes, and the second I is for homeowners insurance. So that's a pretty typical standard. All 4 of those things are in your mortgage payment. And then there's PMI. But back to the interest, this is one of the things, and the taxes, right? Because the taxes are different at all of these different homes. So depending on which home you're offering on, the amount of property taxes will change your mortgage payment. And interest. Interest has interest. The amount of interest that a lender offers you is not only dependent on the lender, but a bunch of different of your financial factors. Are there a couple of those financial factors that are going into what you get for an interest rate? Like, just tell me off the top of your head, like what goes in
debt to income ratio,
Mm-hmm.
How much you have down, your percentage down.
Mm-hmm. Yeah. So debt to income ratio, obviously, the higher your income and the lower your debt, the smaller this is, then you can get a better interest rate. And the higher it is, your interest rate is more. So that's the debt to income ratio. Percentage down. I think that it's a lot of moving factors, but I believe that at 5%, 10%, 15%, 20%, every time you hit one of those levels, I think your interest rate goes down a little bit more. What else? Credit score. That's the other one. Yeah. And there's definitely videos on the channel about credit score secrets. So check those out because like the debt to income ratio and like the down payment amount, the higher your credit score is, the lower your interest rate's going to be. And I believe that those are every 20 points. So like for 650, 680, 700, 720, every time you hit another one of those levels, your interest rate might be down a little bit.
Tell me about PMI.
Yeah, PMI is, so just an explanation of what it is. Private mortgage insurance. And it's basically like if the lenders don't think that you have enough skin in the game, then they will charge you private mortgage insurance. So as an industry standard, they have said, hey, look, if you have 20% or more that you're contributing to the purchase price of the house, then you have enough skin in the game and we're not going to charge you PMI. But anything under 20% typically is going to come with some amount of PMI added into your monthly mortgage. But the interesting thing is that I actually only recently found this out, that PMI, the rate changes all the time, just like the interest rates change. And just like the interest rate, your PMI amount is dependent on your credit score, the amount you're putting down, your debt to income ratio. And it can be as low as $40 a month or maybe even up to a couple hundred a month. So that's what PMI is.
Does that private mortgage insurance change each time you make your payment, or is it's going to be one price throughout the entire loan?
That's a great question. It is one price, but on an it depends on the type of loan. So on an FHA loan, that private mortgage insurance is going to be part of your payment, the same every month, part of your payment for the life of the loan. So the whole 30 years. Now, once you have enough equity in your house that you don't necessarily need private mortgage insurance anymore, it's a really smart idea to refi at that point. Or, if you can pay the loan off, but you have to get into a new loan by refinancing in order to get rid of the PMI on an FHA loan.
Well, what about a conventional loan?
Great question. So on a conventional loan, on your amortization schedule, which is, month by month by month for 30 years, there is a date in there where they say, okay, on this date, you made enough payments towards the house that you should have that 20% equity. And so they will automatically drop PMI off of your loan on that date, and your mortgage payment will change and come down. However, your house appreciates, and there's a couple of different ways that it can appreciate, right? So forced appreciation is like if you're doing upgrades, remodels, you're making it nicer, you're making the home worth more. Its market value is now worth more than when you bought it. That's one way it appreciates. Another way it appreciates is not only by paying down the loan, but also typically in our market, decade over decade, houses appreciate 5 or 6% every year pretty steadily. Now there's difference, right? Like the COVID years, some of those houses appreciated 50%. So, somebody who had an FHA loan, or I should just say somebody who had PMI on a loan in 2018 or 2019, after they went through COVID and their value raised because of the appreciation from that time period and what was going on in the market, they could easily have more than 20% equity by the time we get to 2022. And you can literally just call and ask them to take it off. And they have a process that they would go through, but they will take it off.
Nice.
Yeah.
How do you know so much about mortgages? I thought you just sold real estate.
I think it's the same way I know so much about water heaters.
It's a hot topic.
I'm just absorbing it, right? I'm in the business, I'm working in the business, doing deals and learning a little bit all the time. And so I've just picked this stuff up over the years, but I am not the mortgage expert. The mortgage experts are the ones who can really dig into your financial situation and current interest rates and everything else. And they're the ones who can tell you, okay, so for a $900,000 house or 600 or 1.5, whatever it is, it's the mortgage lender who is the expert in figuring out what is your monthly payment going to be. And just as a little, I don't know, is it an advertisement? I don't know. I know that one of my preferred lenders, Nicole Ruth with the Ruth team at Movement Mortgage, she does a ton of videos. And if you scroll through some of her videos and reels, you can definitely find some things that she's put out that say, this is kind of a ballpark payment that you could expect for a house at 400, at 500, at 600. So she's really good about laying out scenarios, and, it's best to do the application, upload all your documents, and get the numbers based on your situation. But if you want to get some more info without doing that, you could definitely go check out Nicole Ruth's channels and see some of the estimates that she's put out.
This is just a quick question, but Do those mortgage calculators on websites or on Zillow or any other mortgage website, do they actually work?
I think they do work, but the output is dependent on the input, right? So that mortgage calculator is calculating a 30-year mortgage based on what you're telling it. So you're telling it, this is how much I'm going to put for a down payment. And when you pull up the mortgage calculator, it's likely that you put in a purchase price and it would automatically put in a 20% down payment. You don't need 20%, but you should be able to change that number. So maybe you can get into a house with as low as 3.5%. So pick a purchase price, figure out what 3.5% or 5% down is, put that in the down payment. And then you could look up today's mortgage rates. But again, the mortgage rate that you're going to be offered is dependent on your credit score and your debt to income ratio, and how much down you have. So you could get a ballpark with a mortgage calculator for sure. You can get a ballpark, but it's not going to be exact without doing the application and uploading your documents.
That's good stuff.
How can we end this well?
I just did. I winked at the camera.
Nice. If you like this content and want to support the channel, don't forget to hit the like, subscribe, and alert bells before you go.